The commercial construction industry added $890 billion in value to the economy in 2025. It is an absolute powerhouse. But here's the crazy part. 80% of the firms doing the actual building will fail within 2 decades.
Yeah, it is staggering.
And they're not starving for work. They're going bankrupt because of the work they actually win.
Right. It is really one of the most counterintuitive dynamics in modern business today. I mean, you would naturally assume that securing a massive contract guarantees financial stability.
Pop the champagne.
Exactly. But in this sector, winning a bid is often the very catalyst for a company to just completely collapse.
So if you are listening right now, you know how real this is. Whether you are a general contractor, a specialized subcontractor, or just someone fascinated by economics. That is our mission for this deep dive today.
Absolutely.
We're going to uncover the hidden financial traps that are actively killing contractors right now. And more importantly, we will look at the modern strategies they use to survive.
Because the rules of survival have completely changed over the last couple of years. It is a critical conversation.
It really is. So we are looking at a massive stack of 2025 and 2026 industry briefings to figure this out. We have data covering heavy fleet operations. We have macroeconomic trends.
And the explosive growth of alternative financing.
Right. Okay, let's unpack this. How is it mathematically possible? A company wins a multi-million-dollar bid. They celebrate. And then they just go completely bankrupt before the foundation is even poured.
Well, it comes down to a fundamental shift. Running a construction business has changed. The core theme across all of these reports is pretty clear. Success in construction today relies significantly more on financial engineering than it does on simply moving dirt.
Wow.
Yeah. It is no longer just about operational excellence
Right.
or even having the best crew. It is entirely about liquidity management.
Which means we need to look at the timeline of a typical project. You win that massive bid, the excitement lasts for about 24 hours.
If that.
Right. Then the math sets in. And you are staring down the barrel of what the industry calls the mobilization gap.
The mobilization gap is the silent killer of construction firms. It is a brutal 60 to 90-day cash void. It happens between the day you start mobilizing for a job and the day you receive your very first progress payment.
The first check from the project owner.
Exactly.
Let's break down the mechanics of that gap. Because it is not just a period of zero income. It is a period of massive, accelerated spending. You do not just show up to a site with a hammer.
No, not at all. Let's list the immediate out-of-pocket costs a contractor faces. This is before they see a single dime. First, you have surety bond premiums.
Stop right there.
Yeah.
Because we hear that term a lot. For someone outside the immediate finance office, what exactly is a surety bond in this context? And why does it drain cash on day one?
So a surety bond is essentially an insurance policy, but it protects the project owner, not the contractor.
Oh, interesting.
Right. It guarantees that the contractor will fulfill the terms of the contract and pay their subcontractors. If the contractor defaults, the surety company steps in to finish the job.
Okay, that makes sense.
But here's the catch. The contractor has to pay the premium for this bond up front. And these premiums generally run 1 to 3% of the total contract value.
So if you just won a $10 million school build, you owe up to $300,000 in cash before a single shovel hits the dirt.
Precisely. That is a massive chunk of liquidity gone immediately.
Yeah.
And then you have heavy equipment logistics.
Right, moving the machines.
Yeah, paying to transport yellow iron to the site.
Yeah.
You have fuel costs, securing permits. And of course, the largest immediate drain is labor. You are paying your crews weekly or biweekly, and you do that for 2 to 3 months before the client pays you for their time.
You are effectively acting as a zero-interest bank for the project owner.
Yeah.
You are literally floating their construction costs for the first quarter of the job.
You are.
But the cash flow crunch does not even end when that first progress check finally arrives.
Yeah.
Because it is never for the full amount you bill.
No, it rarely is. This introduces the retainage trap. Project owners typically hold back 5 to 10% of the total approved payments. They hold it until the very end of the job, sometimes waiting until final completion and formal sign-off.
I have to push back on the logic of this from the owner's side. Why do project owners aggressively hold back retainage? They know contractors are already bleeding cash just to mobilize.
It is a controversial practice.
Right. If a contractor's average profit margin is only around 5 to 8% anyway, holding back 10% means the owner is literally trapping the contractor's entire profit margin on their own balance sheet.
Yep.
Are they not just risking the bankruptcy of the very people they hired to build their building?
Well, from a purely functional standpoint, yes. but it is rooted entirely in owner risk mitigation. From the owner's perspective, if a contractor walks off the job half-finished or does substandard work that fails inspection, the owner needs financial leverage. They need it to force corrections or hire a replacement crew.
So they hold the money hostage.
Exactly. They use that 10% as a hostage to ensure quality. However, your point is completely validated by recent data.
Oh, really?
Yeah, this traditional risk mitigation strategy is actually backfiring in the current economic climate. Project abandonment spiked by 88.2% in late 2025.
Wait, 88.2%. That is nearly doubling year over year. That implies something in the system fundamentally broke.
It did, and it was not because contractors suddenly became lazy. It was because firms looked at the math. They saw the mobilization gap combined with the retainage withholdings.
And they saw the writing on the wall.
Right. They realized that starting the job would put them in an unrecoverable cash deficit, so they simply walked away. They surrendered the contracts rather than bankrupt their companies trying to float the initial costs.
Wow. So when human labor simply is not an option, either because the cash flow is not there, or because the operational costs are soaring, contractors really only have a few levers left to pull.
Very few.
Let's look at the broader economy, because surviving that 90-day gap is exponentially harder now than it was even 5 years ago.
The macroeconomic headwinds right now are fierce, particularly regarding materials and international trade. The evolving trade policies push the effective tariff rate for construction goods up. It hit between 25 and 30% in 2025.
That is massive.
It is. For highly specific materials like certain grades of structural steel and aluminum, we have seen tariffs hit as high as 50%.
Let's explain the causality of how a tariff actually drives a contractor to bankruptcy. Because it is all about the timeline, right? A contractor bids on a project in January based on current steel prices.
Correct.
They win the bid, they sign a fixed price contract. But they do not actually purchase the bulk of that steel until mobilization in April. By then, a new 30% tariff is hit.
And they are stuck.
Because it is a fixed price contract. The project owner does not pay a penny more. The contractor has to eat that 30% increase entirely out of their own margin. The profit is literally gone before the foundation is poured.
That is the exact mechanism. You are legally bound to deliver a building at a price that no longer reflects reality.
It is terrifying.
It is. And then we add the human element. The labor pool is not just tight. We are looking at a terrifying demographic cliff for the industry. By 2031, 41% of the current construction workforce is going to retire.
Oh, man. That is not just losing bodies. That is a massive brain drain. You are losing decades of institutional knowledge, project management intuition, physical capacity, all in a very short, unforgiving window.
And the financial impact of that shortage is brutal on the balance sheet. Because there are fewer qualified workers, contractors are locked in an aggressive bidding war for talent.
Right, supply and demand.
Exactly. The reports show wages are growing at 8 to 12% annually. That completely outstrips the national average for wage growth.
So what did that look like for a specific role?
Well, if you need a specialized, experienced project manager right now, you are looking at paying up to $140,000 just as a baseline.
Wow.
And in high-demand regions, you are paying heavy premiums on top of that just to get them to answer the phone.
It is like trying to run a marathon while someone slowly drains your oxygen tank.
Yeah.
You are pouring effort in. You are winning massive bids, scheduling the work, mobilizing the site.
Yes.
But the unpredictable tariffs and the escalating labor premiums are draining your margins. They drain it before you can ever actually take a profit.
That is a highly accurate way to visualize the cash flow mechanics at play here. And to add another layer of complexity to that, we have to look impartially at recent political factors.
Right, the enforcement policies.
Yes. Regardless of where one stands on the broader policy debate, the immigration enforcement actions in late 2025 and early 2026 had a profound, immediate operational impact. The data shows that 1/3 of construction firms were directly affected.
Meaning they simply lost their labor overnight.
Correct. Workers did not appear for their shifts, and projects ground to a sudden halt. This was particularly bad in the South and West.
Which just exacerbates the mobilization gap. Because if your project is delayed because you have no crew, your progress payment is delayed. But your equipment rental fees, your insurance, and your bond premiums are still ticking away every single day.
Every single day.
So high labor costs and unreliability naturally force companies to pivot. If you cannot rely on human capital, you substitute it with physical capital. You rely heavily on machinery.
You have to.
But the briefings point out that owning massive fleets of heavy machinery is a trap all by itself.
It is. Heavy equipment requires rigorous, relentless life cycle management. The data reveals that construction fleets average 38,447 miles yearly.
That is a lot of wear and tear.
It is incredible wear and tear. They are operating in highly abrasive off-road terrain. They are constantly hauling maximum loads, frequent idling.
And when a contractor is stuck in that cash-draining mobilization gap, what happens? The first thing they do to preserve capital is defer buying new equipment.
It's exactly.
They skip the upgrade cycle. They just keep running the old trucks and excavators, hoping they hold together.
Which is a deadly financial miscalculation over the long term.
How so?
The data is unequivocal here. Deferring replacement creates a cascading financial burden. Assets over 10 years old cost 35% more per mile to operate.
35% more.
Yes, you are paying a massive premium in fuel inefficiency. You have escalating emergency repair costs. And most importantly, job site downtime.
Okay, here's where it gets really interesting. Because the smartest firms are not just blindly buying massive fleets to avoid downtime. And they are not blindly renting everything either. They are adopting something the reports call the core plus flex strategy.
It is a brilliant, highly disciplined approach to asset management. The core plus flex strategy dictates that smart firms buy the core machines they need for daily use. Things like standard excavators, bulldozers, or loaders. Machines where utilization is consistently above 60 to 70%.
Because purchasing those builds equity on the balance sheet. Right. But they rent specialty tools, like hydraulic rock hammers or massive articulating cranes. They rent these to avoid the maintenance liabilities and rapid depreciation. You only need those for very specific short-term project phases.
And the government recently changed the mathematical incentives for buying those core assets. In July 2025, they passed the One Big Beautiful Bill Act, or OBBB.
Yes, the OBBBA.
Among other things, this law reinstated 100% bonus depreciation, and it raised the Section 179 deduction limit to $2.56 million.
This is a vital piece of the tax strategy puzzle. Section 179 allows a business to deduct the full purchase price of qualifying equipment in the year it is placed in service, rather than depreciating it slowly in small increments over a decade.
Wait, let's break down the OBBBA and these deductions, because tax code usually makes my eyes glaze over. What does 100% bonus depreciation actually mean in practice? Let's say for a contractor staring at a $300,000 price tag for a new excavator.
Normally, if you buy a $300,000 asset, you deduct its loss of value over 10 years, maybe $30,000 a year off your taxable income.
Okay, standard depreciation.
Right. But bonus depreciation allows you to take the entire $300,000 deduction in year one. It can dramatically lower your tax bill. In fact, it can even generate what is called a net operating loss, or NOL, which is highly advantageous.
Because an NOL is not just a paper loss, right? If you generate a massive net operating loss this year by buying equipment, you can often carry that loss backward to amend previous tax returns.
Precisely.
You can essentially get a cash refund on the taxes you already paid to the IRS in prior, more profitable years. It acts as a sudden cash injection.
Exactly. It turns a tax liability into a liquidity event.
But I have to raise a skeptical question here about the reality of this strategy. We just spent 20 minutes talking about how contractors are starved for cash.
True.
If a contractor is facing a 90-day mobilization gap where they have zero cash coming in, does buying a $300,000 excavator just to get a tax break actually drain the critical cash they need to survive? I mean, isn't that just trading a long-term tax problem for an immediate bankruptcy problem?
That is the exact paradox contractors face. And it perfectly illustrates why financial engineering is more important than moving dirt today. You have hit the nail on the head. If you drain your liquid cash reserves to buy an asset outright, you will not survive the gap, tax break or no tax break.
Also, how do they thread that needle? You need the equipment to do the job. You want the tax break to recover past taxes. But you cannot spend your cash reserves.
Right.
That means you have to rely on external funding. You have to finance the equipment to keep your cash in the bank for payroll.
Yes, you leverage external capital. But here is where the traditional financial system fundamentally fails modern contractors.
How so?
If you go to a traditional bank for a commercial loan or an equipment lease, they typically take 4 to 8 weeks just to move through the approval process. They underwrite based entirely on your history, asking for 2 to 3 years of audited tax returns.
That is a long time to wait.
It is. And they demand a pristine personal and business credit score, usually 700 or higher.
But the reality on the ground is that the construction industry moves at a speed that traditional banks simply cannot comprehend. You might win a bid on a Friday afternoon, and the contract dictates that you must mobilize the site by the following Monday week.
Exactly.
You do not have 2 months to wait for a regional loan committee to sit around a mahogany table and review your 2023 tax returns. You need money for your future, but they are stuck underwriting your past.
And that profound misalignment between the speed of construction and the speed of traditional banking has fueled a massive alternative lending boom. The global alternative lending market is exploding, precisely because they have replaced slow, manual underwriting with technology. Lenders now use AI models and open banking APIs to connect directly to a business's operational accounts.
Let's explain that API mechanism, because it is the secret sauce of this whole lending revolution.
It really is.
Open banking APIs allow the lender to plug directly into the contractor's bank account in real time. They are not looking at a stale tax return from 2 years ago. They're looking at exactly how much cash cleared the account yesterday.
Yes. They are evaluating real-time revenue patterns and cash flow consistency, which allows them to fund deals in 24 to 72 hours.
That is incredibly fast.
Furthermore, because they have access to real-time data, they are far more forgiving on historical criteria. They frequently accept credit scores as low as 500.
Wow, really? 500?
Yes, because they are underwriting the current cash flow and the collateral value of the specific asset or project. Rather than strictly relying on historical FICO scores, it provides unparalleled speed and access. But naturally, it comes at a different kind of cost.
The cost is fascinating, especially when you look behind the curtain at how these lenders operate. The marketing metrics in this space are completely insane.
They are very aggressive.
These alternative lenders are fighting tooth and nail for contractors' attention. According to the 2026 standards, it costs lenders an average of $20,842 to acquire a single equipment finance customer.
It is a massive acquisition cost.
And the sales cycle takes 180 days on average, with 46 different marketing touchpoints required just to get a single conversion.
It is a high-cost, incredibly high-touch environment.
But when you think about it, spending $20,000 to acquire one customer makes perfect sense. You just have to consider the lifetime value of a construction firm. If a contractor is borrowing $2 million to fund a fleet of excavators and bridge a massive mobilization gap, and they are doing it at alternative lending rates, the interest generated is astronomical.
Exactly. Because the lenders are taking on more risk by funding rapidly and ignoring credit scores. And because they are spending heavily to acquire customers, the cost of that capital is substantially higher than a traditional bank.
What kind of rates are we talking about?
You might see APRs starting at 15% and escalating much higher from there, compared to a traditional bank's 5 to 12%.
Which sounds absolutely terrifying on paper. Paying 15 or 20% interest rates when your margins are already being squeezed to death. You have 30% steel tariffs. You have $140,000 project managers. It sounds like a death spiral.
It can be, if managed poorly. But this is where strategic implementation comes in. The briefing outlines what is called the graduation strategy.
Okay, walk me through that.
The core premise is that contractors should never view alternative lending as a permanent state of operations. Instead, you utilize alternative lenders specifically to bridge the mobilization gap. You use their fast, albeit more expensive, capital to secure the job. You buy the core equipment. And you build a rock-solid track record of revenue and successfully completed projects.
You build your credit profile using their money.
Exactly. You essentially use the expensive alternative lenders to scale your operations up. You do this to the point where your balance sheet is stabilized.
And then once you have that strong credit and proven cash flow, you graduate. You transition all of your future financing to traditional banks. To secure that coveted 5 to 12% APR for your long-term needs, you use the alternative market as a stepping stone.
If we connect this to the bigger picture, the contractors who will thrive in 2026 and beyond are those who actively manage their total cost of ownership. They are not just looking at the sticker price of a bulldozer. They are meticulously optimizing their taxes through the OBBA provisions. They are strategically mixing owned core fleets with rented specialty tools. And they are utilizing alternative capital safely as a targeted tool for growth, not just grabbing it as a desperate lifeline when the bank account hits zero.
It is a complete mindset shift. For you listening, it means you need to calculate your true cost of capital against the cost of inaction.
That is the key right there.
If you win a $5 million contract, and the only way to survive the 90-day mobilization gap is to take a high-interest bridge loan, That loan might actually be incredibly worth it if it saves a highly profitable project that you would otherwise have to walk away from. It is about doing the cold, hard math on your own survival.
It is the purest form of financial engineering in practice.
And the tools to do that engineering are evolving incredibly fast. We talked about AI underwriting loans via APIs, but I want to leave you with a final provocative thought from the research.
Go for it.
The reports note that agentic AI, meaning AI that does not just analyze data but actually takes independent action, it is already autonomously managing complex job site scheduling and coordinating subcontractor workflows.
It is rapidly moving from a digital novelty to an essential capacity preserver for large firms.
So ponder this as you look at your next big bid. If an AI agent can already identify a scheduled delay in the supply chain and automatically reroute materials to save the timeline, how long until these same AI agents are automatically monitoring your balance sheet, anticipating the mobilization gap, and autonomously securing bridge loans or equipment leases for you the very second you sign a new contract?
That is a wild thought.
Think about what happens to the industry when the massive, terrifying mobilization gap is solved instantly by an algorithm, before you even have a chance to panic. Until next time, keep digging deep.